Welcome back, everybody. This is session 2 of module 2 in the foundation area, and as you recall, in session 1, parts 1 and 2, we went through the core concepts in accounting. We went through the debits, credits, journal entries, income, expense. We went through kind of those core items. Now we're going to dive into the actual core statements. These are going to be the main statements that you look at in your business. Whether you're doing an internal financial, external financial, these are the main statements that you always want to have familiar with. And of course, these statements are your balance sheet, your income statement, and your statement of cash flows. And so that's what this module is geared towards. Is we're going to go through those statements. First, we're going to go through all the PowerPoint slides and get an idea as to what each statement has and what are the main things. And then we're going to dive into the actual template. Now, the template that I put together is specifically geared to have all the statements interact, and it's not something that you're going to be able to download off the internet. So when you take this template, please keep this secure with your respective records. Don't share this on the internet. This is not something that people out there in the general public will have access to. And when I go through the template, I'll kind of indicate how much this template would really cost if you were to use a CPA firm to put it together. So again, session 2, we're going over the core statements. In this session, we're going to review, obviously, the balance sheet, income statement, statement of cash flows. Now, sometimes you hear it referred to as the cash flow statement. So either way, it means the exact same statement. And then, of course, footnotes. We'll briefly touch on footnotes, and this is just a real touching on that just so you get an idea that footnotes are out there, but we're not going to go through and put together footnotes for your financials. That's more of an item that you would do if you had an audit or a review done. And of course, again, like I said, we're going to go through the template and we're going to go step by step through that process. Now, the balance sheet. Of course, the first thing, I say this tongue-in-cheek, but your balance sheet should balance. And I say that I've actually seen a balance sheet come out of a CPA firm that they issued that they literally did not balance. Granted, it was off by $1, but still it didn't balance. And so that's the biggest thing. The balance sheet is, does it balance? And of course, the formula for the balance sheet is your assets should equal your liabilities plus your equity. Now, your equity can be your members' capital and capital contributions. However your structure is, will be your equity. So that is really just the basic formula on the balance sheet. Now, there's another aspect with the balance sheet, and it's called classified versus unclassified. Now, this is just a big fancy term that accountants use, but really the difference between classified and unclassified is on a classified balance sheet, you have a subcategory for total current assets, you have a subcategory for total current liabilities. That's really the only difference. An unclassified balance sheet won't have those subcategories in there. A classified balance sheet will. Now, when we get into module 3, we'll start talking about ratios, in particular the current ratio. And what you want to do going forward is you want to make sure your balance sheet is in the classified format, i.e. it has a total of current assets and it has a total of current liabilities. The reason being is you're going to use those numbers for a lot of ratios and a lot of analysis. So just get used to it now, get it set up in your system so it just makes your life that much easier. Now, it's important to realize the balance sheet represents a point in time. So what that means is when you see a balance sheet, there's usually a date at the top. It doesn't say for the 6 months ended or anything. It just says a date. So when you have a balance sheet, it's December 31st, 2019, or January 31st, 2019, or March 31st, 2019. What that's saying is, as of this date, here's what the total cash is, here's what the total liability is, here's what the total AR is. This is important because when we get to the income statement is a period in time, not a point in time. So there is a distinction there. So it's always important when you're looking at a balance sheet, it's as of that point in time. Sometimes when I would work with staff when I was in public accounting, I would tell them the best way to think about a balance sheet is if you stop doing business, or if this company stopped doing business on this day, And usually we would audit as of December 31st. So if this company stopped doing business as of December 31st, what would their total assets be? What would their total liabilities be? And that was how I got them thinking about that point in time what the balance sheet really was. Now, again, this goes back to session 1. We talked about accrual accounting. Accrual accounting is key to a proper balance sheet. If you don't have all your liabilities that you've incurred recorded on the balance sheet, and you don't have all your revenue that you've earned recorded on the balance sheet, i.e. in the accounts receivable, then you can't really analyze your balance sheet. And this has like a trickle effect. You can't project or forecast your future earnings or your future revenue that comes through. So it is very key that your balance sheet and conversely your income statement is on the accrual basis of accounting. And when you put your balance sheet together, it is standard practice that it's listed in order of liquidity. And what that means is, if you've ever looked at a balance sheet, what's always at the top? Cash. Well, what's the most liquid asset you have? Cash. Then after that, you'll probably have accounts receivable, maybe a prepaid, then inventory. So it goes in the order of what can be liquid or converted to cash the fastest, and that's the order you have your balance sheet. So that's why when you look at a balance sheet, you always see fixed assets is always kind of down at the bottom, and sometimes there's assets that are below fixed assets, and that's kind of a different reason for that. But in essence, your balance sheet, both the asset section and the liability section, should go order of liquidity. So even in your liability section, your accounts payable should be the very first account. The only time that accounts payable won't be the first account in the liability section is if you have checks in excess of bank balance. And that's really just an accounting entry, so don't worry too much about that. But even your liabilities will go in the order of what has to be paid first. What is the most pressing item that needs to be paid first? Your income statement. Now, your income statement represents total revenues less expenses for a period. Obviously, I've harped on accrual accounting, and I'll keep harping on it. Your revenues is what you have earned, regardless of whether you've been paid for it yet or not. It's what you truly have earned. And then your expenses are truly for the expenses for a period. So if you're currently in 2019 fiscal year, all your expenses that are related to 2019 will show up on the expense side. So if you have an expense that was a 2018, it should not be in your 2019 financials. I know that seems kind of obvious, but there have been times I've seen where expenses from the wrong period get put into the wrong income statement. And what happens on that is that messes up your analysis. And as you'll see as we progress through all these modules, is we need to make sure all the data is accurate and correct, because we can't forecast, we can't project, we can't say, okay, the owner of this company wants to sell it for $5 million in 10 years from now. Well, for us to get to that point, we need to make sure all the information is accurate and correct as we go through. Now, the dating of the income statement is for a period ending. So when you look at an income statement, you look at the heading, it'll say, Apple Incorporated income statement, and it'll be for the period ending December 31st, or for the 6 months ending June 30. So it's always going to be for a period. It can be a month, it can be 2 months, 3 months, it can be for an entire year. You just need to make sure you understand what you're looking at, what the period is encompassing on that. And the reason being is, again, a lot of the software that you guys will be using, the accounting software, whether it's QuickBooks, FreshBooks, Xero, what have you, usually has the ability to print an income statement for a month. So if you're in the month of October and you get an income statement for October, and you're also looking at an income statement for January through October, you need to understand what you're looking at time frame wise. Because if you're looking at a different time frame, let's say you're looking at 6 month and you're thinking you're looking at a 10 month, that could mess up your analysis on there. So it's important you understand the income statements for a period of time and also what that period is. That period should always be somehow delineated in the header on the date. Now, the income statement can be referred to as a profit and loss statement, P&L statement, statement of operations, and sometimes even an earnings report. Now, the term earnings report usually is for public companies, but I just put that in there so you hear that. But I just want you to see this as there's a bunch of different terms for the exact same statement. So if you hear somebody say, print me your P&L, and you're used to thinking income statement, well, they're talking about the exact same thing. And P&L obviously is just profit and loss. And statement of operations, that's normally a term you would hear in the not-for-profit world, but I have seen for-profit companies call their income statement a statement of operations. So I just want to make sure you understand kind of that terminology. Cash flow statement. Now, the cash flow statement takes an element of the balance sheet and income statement and converts them into how much cash was produced or used by the company. Now, we're going to go through the process and we're going to go through a worksheet on the cash flow statement. But this is probably the most important, most valuable statement in all your core statements. However, like I say, it's also the most difficult to produce. And we're going to go through the process, and it doesn't mean you have to produce one, but I want you to understand how everything flows through. And again, on this template, I'm going to have formulas in there that at the very minimum you can drop them in and get a fairly good idea as to the cash flow of your company. Now, cash flow statement is broken down into three main areas: cash from operations, cash from investing, and cash from financing. Now, of all these things, cash from operations is the biggest number. Now, I was a partner in an audit firm, and when I would look at the financials of a client we just audited, the first place I would go is cash from operations. I could look at income or assets or whatever. I always looked at cash from operations. Now, why is that? Well, the statement of cash flow, it gets rid of all the accrual noise, all the accrual stuff that we need for analysis, and it really breaks down to how much cash did this organization produce, and did this organization actually fund their operations. And so that cash from operations, if that number is positive, that's usually a good sign. That means, hey, I brought in enough cash to fund my operation. I can keep doing business as XYZ company. If that number is negative, now sometimes that negative could happen because of timing issues, but if it's negative and it's been negative for several months or for the last year, then we've got some serious issues, some serious planning need to take care of, because otherwise that company will probably end up into bankruptcy. And the reason why I look at cash from operations, there's a saying that you learn in college in your accounting classes is, and it's true, is I as an accountant, I can make you, the client, as profitable as you want to be. Doesn't mean it's going to be accurate or correct, but I can make your net income as big as you want it to be. However, when you get to the statement of cash flows, you can't hide that. So in other words, if you think about if I wanted to make a company, if the company has 11,000 net income and I want to double that, well, an easy journal entry is I debit accounts receivable 11,000, I credit revenue 11,000. Hey, my net income just went up 11,000, now it's 22,000. But when we get to the statement of operations, it clears out all that stuff. So that's why I like the statement of operations. Now, cash from investing, that is strictly how much cash did you pay to purchase fixed assets, how much cash did you pay for purchasing a CD or mutual funds or any kind of investment, how much cash did you get from selling those. So that's truly just cash investing in the company. And then cash from financing, again, that's the easy one on there is, did you take out a loan? Are there loan proceeds coming in from financing, or are there payments going out for the loan? The other thing that comes through financing is any capital calls. Did you have a capital call on and had additional stock sale, or Conversely, did you have a dividend payout? If you're a partnership, did you pay yourself and your partner a dividend? That shows up in the financing. Again, that's not an operation thing, so that's why these items fall into either investing or financing. It clears that out so you can truly see what was your cash flow from operations. So that's why I absolutely love this statement. Now, footnotes. If you've ever had an audit or review done, your accountant will produce footnotes to the financial statements. Now, footnotes are really just a summary of significant items in the fiscal year, and they're kind of like a story on the fiscal year. The footnotes will go by the order of the balance sheet. So if you have accounts receivable, footnote 1 is always like a general footnote, but the next footnote will probably have accounts receivable. The next footnote after that will have your inventory. Next footnote will have fixed assets. So it's just in that order, and these are material. So if your accounts receivable are just $10, they're probably not going to do a footnote for that. But you only need to worry about footnotes if you're having formal statements produced by an independent accountant. So we'll quickly go over some footnotes that you see in public companies. However, we're not going to go into that, and you don't need to worry about it. I just want to let you know that footnotes are a part of the financial statements, what they call, quote, a full set of financial statements. So I just want to let you know about that. Now, how do all these statements tie together? That is the key, and that's really where we're going to now get into the meat and potatoes of this whole thing, is we're going to see how everything flows through. And the importance of this is it's going to help you see kind of, I hate to use the cliche term, outside the box. You're going to start seeing how everything interacts within your company, both balance sheet, income statement, and all that through. So let's go ahead and walk through this template on the core statements. Okay, so here we are on the template for the core financial statements, and each of these tabs is going to have the respective statements. And the beauty of all this is all these respective statements are linked back and forth, and I'll show that to you when I start changing some numbers, and you kind of see how things change. But this template alone, you would not be able to download this from the internet. If you did download something like this, it would probably have some viruses. But if we were going to have a CPA or CPA firm put something like this together so you could use it and kind of use it as your template going forward, it would probably cost you anywhere, depending on billing rates for where you live, anywhere from $600 to $700 just to put this together. So I want you to keep that in mind when you're looking at this. This is your template to use, and it's part of the package that you've purchased. So please keep that with you and keep that on your respective hard drive, but don't publish it on the internet, because more or less if you do, you're just going to be giving somebody else something that is a benefit to you. So just keep that in mind. So as you can see, balance sheet, income statement, cash flow, and then of course we get to the cash flow worksheet, which we're going to walk through that particular process. So let's go back to the balance sheet. So as you can see, sample company, again, put in your company name, balance sheet, and then you see December 31st, 2018 and 17. Remember, the balance sheet is a point in time. So what this is telling us, this header, is saying this is the balance as of December 31st, 2018, as of December 31st, 2017. Now, when you have a balance sheet, you want to make sure you have at least 2 columns. You never want to have a balance sheet with 1 column. The reason being is you can't compare. So if I were to do this and I looked at this, and let me just hide this real quick and I'll show you what I'm talking about. If I come up here and I hide this column, and this is just all I see. Okay, here's the accounts receivable 15,000. Well, what does that tell me? If I can't compare it to a similar period or similar year from either last year, last period, what have you, I don't know if that number is reasonable. Is it comparable? Is it too high, too low? What is it? So you always want to have comparability in your financial statement. So always have at least 2 columns. Even if you're using QuickBooks and you're just printing out the balance sheet for March of 2019, well, make sure you have either February of 2019 to compare it to, or March of the same period of last year. Somehow have something that you can compare it to. So, as we talked about, in the previous session, here's current assets and here's current liabilities. So, based on what we talked about in the previous session, what does that mean? That means that this is a classified balance sheet. And again, you want to make sure your balance sheets are classified. The reason being is when we get into ratios, and you're going to start using ratios in Module 3, you want to have these numbers ready and available. You don't want to have to go back and add up all these numbers and add up all these numbers and these numbers and so on and so forth. Have it there so you can grab it. Also, you want to have a good idea as to what your current assets are and what your current liabilities are, because one, it helps you operational standpoint, and two, when you meet with a banker, because eventually you're going to want to expand or get a new building or what have you, you want to be able to have that off the top of your head to be able to say, hey, Mr. Banker, hey, my current assets are this, current liabilities are that. Bang, get used to seeing those numbers and being able to identify those numbers. So as you see, like we said, the balance sheet should go order of liquidity. Obviously, first item is cash. Cash is going to be the most liquid item, so here it is. Next item, accounts receivable, and then prepaid. Again, prepaids usually aren't too terribly liquid, so that's usually why they come after accounts receivable. And then that culminates to our current assets. Next is our fixed assets, or a lot of times what you'll see is PP&E, property, plant, and equipment. So fixed assets, PP&E, they mean the same thing. And of course, listing out what are all your fixed assets. In this case, I just made up a building of $50,000, which probably is a little too cheap, but we have building, equipment, vehicles, and then our accumulated depreciation. Now recall from the last session, accumulated depreciation is one of those, quote, contra accounts. So it's a contra to an asset, even though, as you see here, it's got the brackets, so that means it's a credit balance within the actual assets. What that means is it's a contra to all these fixed asset accounts. And so you always want to have your accumulated depreciation with your fixed assets either netted already within each one of these, or the easiest way is just have it separate account. Then you come down to your fixed assets net, and what that net number means is the fixed assets are net of the accumulated depreciation. So then you come down to your other assets, which again, like I said, I just put some numbers in here so you could see how everything flow through, and then we come down to our total assets. Now you'll notice throughout here you're seeing these lines all over the place. Now these lines aren't here for aesthetic purposes. They're there for a specific reason, and the reason being is anytime you see lines like this, they usually indicate, at least in the accounting world, that it's a summation of certain numbers. So in this case, obviously it's a summation of these numbers. In this case, it's a summation of the fixed asset numbers. So you notice this other assets doesn't have any lines there. Well, that's because it's not a summation of anything. And then you get down to total assets, which will always be double underlined or double underscored, depending on how you want to say it. And what that means is that's the total. So anything after this number is something completely different, which in this case is going to be the liabilities and equity. So just want you to understand that when you see a statement, what these lines mean, and so that it's easier when you're going through that process. Now we get to liabilities and members' equity. Now remember our formula for the balance sheet: assets equal liabilities plus members' equity. So as we come down here, we'll just do this real quick. Total assets $87,165. Liabilities and members' equity $87,165. Lo and behold, our balance sheet balances. Great. that's a great start right there. And so coming back up here, our liabilities. Again, current liabilities, that's how we want it. We want a classified balance sheet. Very first item, what is going to be paid first, or most likely to be paid first, i.e. kind of the liquidity on the liability side. Well, the very first item is going to be your accounts payable. Of course, there we go. Then accrued liabilities. Now I broke these out here just so you can see it, but a lot of times accrued liabilities may be a number, and then you have to drill down within the accrued liabilities to find out what it's made up of. So theoretically I could have taken these two numbers and just put it up into here and said accrued liabilities. Well, I wanted you to be able to see what traditionally is going to be under accrued liabilities. And of course, in this case, interest payable and payroll payable. Now, a unique item within the balance sheet is this concept of current portion of notes payable. So if you have a note or a mortgage payable, you're probably going to have some portion that you have to pay within 1 year. So the mortgage on your house, all your mortgage payments of the principal, now keep in mind it's just the principal portion, not the interest portion, just the principal portion is what's going to be considered payable or current portion, i.e. keep in mind this is something that's payable within 1 year, and I think they say the correct terminology is like within 364 days of the fiscal year. So you will always see a current portion of notes payable, and if we had a line of credit, you would see that up in here as well. So that gets us our current liabilities. So if you've ever gone to a bank and you applied for a loan and they say, well, your current ratio is this, and you're looking at like, how do they come up with that? A lot of times it's because of the current portion of the notes payable, mortgage payable, bond payable, whatever it's classified as. There's always that current portion. So that's what they're looking at sometimes. So if your current ratio, you calculate it one ratio and they calculate another, a lot of times it's because of that. So then we come down to notes payable. Again, this is a long-term liability. And you see it's net of current. So honestly what that means is here's what the note is, and we pulled out the part that's due within 12 months, and so this is what the long-term portion is. So that's always what that means, that net current is net of the current amount. Then we get to our total liabilities, and again that's just our current liabilities plus our long-term debt. Now there's one item up here in the current liabilities that you don't see, and that is deferred revenue. Now a deferred revenue, as we mentioned way back in module 1, is income that somebody prepaid you for a product and you just haven't shipped it out, so you haven't quote earned it yet, and so then it becomes a deferred revenue. Once you've quote earned it, you've shipped the product to them, then you release the deferred revenue out of the liabilities and into revenue. So there's currently not deferred revenue in here, and I didn't want to muddy it too much, but I just want to let you know that that is also another item that shows up under the current liabilities. So got our total liabilities, then we have our members' capital. So in this situation, this happens to be a partnership. So we have our members' capital, and again, members' capital is going to be whatever the members contributed plus any net income. And in this situation, I put distributions in here just so you could see that it sometimes is a separate line item, and distribution would be a negative number. And so we come down to our total members equity, and then total members equity plus liability equals our 87,165. Again, this is our balance sheet. Now I know this is very rudimentary what I just went over, but it's important for you to hear this, because as we get into the statement of cash flows in particular, this will start making more sense why I kind of went through all this process. Because yes, this is numbers that a lot of times your QuickBooks or your Xero will just print out for you, but I want you to get a feel for this, because as we go through, we're going to start seeing this. Now, one thing that I built into the spreadsheet is some conditional formatting. So remember how I told you how I've once looked at a balance sheet that came from a CPA firm that didn't even balance? Well, if they would have put this simple little conditional formatting in it, they would have caught it. And a lot of times what happens is you may even have a transposition error. Let's say this says 87,165 and down here says 87,615 or something like that, or 156. So your mind's eye doesn't see it, and so you don't catch it, and then you hand it to a banker, and of course they're going to look at you like, your balance sheet doesn't even balance. So what I built into this is conditional formatting, so that if your balance sheet doesn't balance, it'll immediately tell you. And this is something that I developed with the firm that I used to be at, because I would see several financial statements just in a day. I've probably looked at maybe several hundred within a year. And when you're pressed for time, you need to look at it real quick. Sometimes, again, your mind's eye doesn't catch something that's wrong, so you let software do the work for you. And in this situation, let's say we had dispute. So currently this balances. So if I put in a one-sided entry, remember when we talked about journal entries that some software lets you do one-sided journal entry? Well, let's say we just did a one-sided journal entry for distributions, and let's just say 15 bucks. Watch what happens to this balance sheet. Immediately it says, wait a minute, this is completely out of balance. This says total assets 87,165. This says 87,150. Now, it'd be pretty easy to just miss that real quick if you weren't paying attention. So that's what's built into this spreadsheet, is to be able to show you, oh crud, I'm out of balance. So I need to look and see why I'm out of balance. So that's why you have conditional formatting is in there. So I just want to kind of show you that, because as we go through these statements, you're going to start seeing all the other conditional formatting that's in there. So now we've been going for about 30 minutes. Why don't you go ahead and take a break, take a look through your notes, gather up your thoughts, and then after you've had a chance to kind of reset yourself, continue on with session 2 on part 2 on the video, and I'll see you on the next video. Thank you.